Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
Everyone assumes the next great stock market winners will look exactly like yesterday's champions. But what if 2026 rewards companies most investors already see, yet fundamentally misunderstand? Market history shows explosive gains rarely follow comfort or consensus narratives. They emerge where structural change quietly compounds beneath widespread skepticism. American markets have repeatedly mispriced technological transitions hiding in plain sight. Railroads, microchips, the internet, and cloud computing all triggered familiar disbelief cycles. Early leaders appeared expensive, volatile, and risky through traditional valuation frameworks. Only later did consensus reinterpret their dominance as inevitable and obvious. The United States now stands at another inflection point driven by converging forces. Artificial intelligence, semiconductor sovereignty, and industrial reshoring are not speculative themes. They reflect policy priorities, capital flows, and national competitiveness concerns already underway. Yet investor narratives often lag behind these deeper, systemic transformations. Consider how computing revolutions historically reshape economic power within American industries. From mainframes to personal computers to mobile ecosystems, value concentrated unpredictably at first. Observers focused on consumer products while infrastructure providers captured disproportionate gains. Markets struggled to price who truly owned the new technological backbone. Artificial intelligence represents a comparable shift with even broader economic implications. AI is not a single product cycle, but a foundational layer across defense, healthcare, and finance. Its computational demands intensify rather than fade as models grow more complex. This dynamic reshapes how investors should interpret certain technology leaders. NVIDIA exemplifies this tension within U.S. equity markets and investor psychology. Originally associated with gaming hardware, it evolved into the engine of AI computation. Its processors now underpin data centers, autonomous systems, and machine learning architectures. Despite this, debates persist about valuation rather than long-term structural leverage. Valuation anxiety has historically shadowed nearly every transformative American technology leader. Multiples appeared stretched precisely when demand curves accelerated beyond existing models. Traditional metrics struggled to capture nonlinear adoption patterns and ecosystem dependencies. The critical question becomes durability of demand, not temporary price ratios. Parallel forces are unfolding within semiconductor manufacturing and national policy priorities. Washington's focus on domestic chip production reflects economic security rather than mere industry support. Advanced semiconductors have become strategic assets, influencing military AI and industrial competitiveness. This context elevates certain companies from cyclical participants to systemic gatekeepers. ASML occupies a uniquely powerful position within this global and American supply chain. Its lithography machines enable production of the world's most advanced chips. Without these systems, leading-edge semiconductor fabrication effectively stalls. Yet many investors still frame the company through conventional industrial narratives. Semiconductor progress depends on relentless miniaturization and escalating engineering barriers. Each generational leap demands unprecedented precision and manufacturing complexity. Capability scarcity transforms specialized equipment providers into critical choke points of innovation. Such bottlenecks historically trigger major valuation reassessments once dependency becomes undeniable. Investor behavior, however, often overemphasizes short-term demand fluctuations and cycles. Temporary slowdowns dominate sentiment while long-term technological necessity receives less attention. This mismatch between perception and structural reality has preceded powerful re-ratings before. Critical infrastructure rarely appears glamorous until growth pressures expose its indispensability. A third transformation is reshaping American markets through electrification and energy transition pressures. Transportation, grid modernization, and battery technologies increasingly intersect with industrial policy. Cost curves and regulatory incentives reinforce adoption patterns across multiple sectors simultaneously. This environment rewards firms positioned at the heart of electrification ecosystems. Tesla remains central to this narrative within U.S. markets and global innovation debates. Beyond vehicles, it influences battery supply chains, charging infrastructure, and software integration models. Market volatility and competitive fears frequently obscure its broader strategic positioning. History suggests dominant platforms often face skepticism precisely during expansion phases. Electrification dynamics echo earlier industrial transitions repeatedly underestimated by incumbents. Initial adoption appears gradual until cost declines and infrastructure growth accelerate feedback loops. Leaders with scale, vertical integration, and technological advantages gain compounding benefits. Delayed recognition of these shifts has historically created asymmetric investment outcomes. What connects these companies is systemic leverage rather than simple sector classification. Each sits near a structural pressure point within expanding technological and economic networks. When entire industries depend on narrow layers of innovation, growth effects become nonlinear. Markets frequently price linear expectations into nonlinear technological realities. Forecasting errors often arise from deeply human cognitive biases within financial decision-making. Investors extrapolate recent conditions instead of recognizing slow-building structural transformations. Short-term volatility distracts from long-term inevitabilities driven by technological progress. Information gaps matter less than interpretation gaps, shaped by psychology and narrative inertia. None of this implies certainty or guarantees that any stock must inevitably surge. American markets remain sensitive to policy shifts, liquidity conditions, and macroeconomic disruptions. However, structural positioning can exert gravitational forces stronger than temporary sentiment cycles. Distinguishing noise from systemic change becomes essential for strategic long-term thinking. 3 lessons emerge from this recurring interaction between innovation, skepticism, and valuation. First, foundational infrastructure often captures enduring value during technological revolutions. Second, discomfort and disbelief frequently precede dramatic repricing events. Third, assuming tomorrow mirrors yesterday may represent the greatest long-term investment risk.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.